now, and I'm also recording it now so that we can upload it and edit it later. But why don't we
Perfect.
just
Yeah.
go ahead and do this and then trust that it's going out on all the different channels. And then I'll circle back with an edited version for more distribution. But I
And the other
thought,
thing is I need sharing permission that you
oh
need
yeah,
to turn on. Yep.
there you go.
So it's like a casual conversation, right? So we just talk about
Yeah, I think the
okay.
thing that's most relevant to talk about is what's happening in the market now.
Mm.
So from what I've been hearing, it's down rounds and people have to get creative with financing, and that there's a lot of great
Yep.
companies that are not getting financing that they would have gotten or easily have raised with the current metrics that they have.
Yep.
But and under the current market conditions, which I think will be persistent for at least the next year,
Yep.
what does it look like? And how can founders be more thoughtful in their capital raises? And that I think the killer thing that you guys do is your round simulations. And so if we
Yep.
could go through a round simulation and show how different instruments affect someone's raise, that would be fantastic, because I think that's one of those tools that every founder should take the time to really be thoughtful and not just take the money, because it can be pretty complicated when you have all these different notes to understand what you've even sold and what you have left. And I know
Okay.
as an investor, it's extremely complicated to understand what I've bought without sort of like the understanding of who else is in the round. Okay,
Okay. Perfect. Okay. Cool. So
that's
I
what
think
I'd love to see.
what I can do is I can just talk about down rounds in general. So the real term within term sheets that impact down rounds. And then I'll walk through a simple scenario so the intuition is understood, and then we can talk about what I see in the market with respect to different cap tables. So yep, that's easy.
That's great. Okay, well let's do it. You have permissions, so you can drive.
Okay, cool. So I just prepared like 3 slides just to go over what this looks like. So this morning, Tiana, like I didn't know what the presentation was, and you said, "Hey, can you talk about down rounds?" I said, "Oh boy, she's going right to the guts of what's happening in the market." So okay, so this is a chat about down rounds. What the important
Hold on.
aspect
Let
of.
me tell
Yep.
Google to shut up. Google, stop.
Even the watch does that sometimes, right?
Can you hear her back chatting me right now?
Yep, yep,
The
yep, yep.
robots are taking over. Okay, I'm sorry.
No, even the watch on the, hey, here's what I found. I'll be in the middle of some important conversation. Here's what I found. That's what my iWatch tells me once in a while. Okay, cool. So let's just talk about down rounds and some intuition behind it. Okay, it's about me, blah, blah, blah. My email is Rajesh at Two12.co. Okay, all right. So the interesting thing for founders is the exit waterfall. It's super important that founders keep an eye on this. It is very important as well because even investors are keeping an eye on this. Okay, and it simply says who gets how much in an exit. And from an investor standpoint, they're looking for what is my ROI and what is the IRR for the investment they've made. And as founders, you will be creating these exit waterfall scenarios, which is really the pro forma is the other word for it. You'll be doing this multiple times because every time there's an investor comes in, they're going to ask you, okay, I'll give you $200,000. What's my ROI, IRR? And they're really trying to make a decision about, okay, whether I should invest in this company. And if so, what is my multiple? And because investors are looking at 50 different deals. So they're trying to see, okay, where it would make sense for them. Now, in what has happened all of last year was the market was very frothy. Like it was just unusually frothy, especially in 2021. So we had companies that were raising with pre-revenue companies raising at 40 million valuation, and we had companies with I don't know, $100,000 in revenue raising at 60 million valuation. It is just nuts. So usually what happens is companies come in and they try to optimize incorrectly for very high valuations. And the investors may come in and say that, okay, you know what, whatever, assuming this trajectory continues, I will continue to benefit from it. But you're already valued your company so high that I anticipate in case of a down round, I need protection against the down round. So that's really where the anti-dilution kicks in. So let's just walk through a very simple scenario. So this is a company, Acme, and they've done a seed A round, let's call it a seed A, at $1 per share, and they've taken $500,000 investment. So the investor gets 500K shares, okay? And then let's say the company went and did a seed B round at a $2 per share and raised $2 million and gave the investor 1 million shares. So it's a very simple situation. Now, now let's say the situation is kind of is gone bad. So there is a down round. The company is now raising at a lower valuation than the prior round. Okay, so this is really the what a down round literally means, and that's really what I'm seeing happening in the market today, and that's what I see happening to cap tables. So a lot of bad things begin to happen. Now let's say this is a situation, the company is now doing what is called a seed C round, but they're raising it at 50 cents per share. Okay, so so they were at $1, went to $2, but now the company didn't progress well enough that now they're raising at 50 cents. But they want to raise $1 million to remain relevant. So this investor gets 2 million shares for the $1 million investment. Now the question is, what would happen to these investors? Okay, so if these investors don't have an anti-dilution protection, then even they get wiped out. So they're also getting wiped out along with everybody else. But usually this type of investor who thinks that the company is being valued excessively, most likely will kind of introduce an anti-dilution clause. So that's really where bad things begin to happen. So what I can do is now just go through an example scenario. So usually anti-dilution, typically there's no anti-dilution, but there are different versions of anti-dilutions. It could be like a manual anti-dilution, meaning they're basically saying, I want X multiple on the conversion. It could be the full ratchet. Full ratchet is the most extreme form of anti-dilution. It impacts the common shareholders big time. What this really does for the investor is it 100% protects the investors. Okay, this is the most favorable for investors, the full ratchet anti-dilution. And then you have weighted average. There are different versions of weighted average anti-dilution that puts some elements in the time value of that money. So it is in between no anti-dilution and full ratchet. So those are the different.
Where would you stick like most favorable nation in that stack?
The MFN is MFN is totally different. MFN simply says that if I'm an investor and I'm not valuing a business today, it just means I don't know what your cap is, what your discount is. And if, let's say I'm the investor giving $100,000 into this company. Now, if the company has a down round, then I would come in at that down round value. So that's really what MFN. MFN basically gives the investor the right to come in at the best deal possible within that round. So, but there is no anti-dilution protection there. It just says that, okay, whatever is the best deal that's happening next, I as an investor come into that deal.
Okay, great.
Okay. So now this is the intuition that is very important to understand. The intuition of anti-dilution is as if the original investment. So we'll go through a simple example of modeling it out. So this investor here, they came in at $2 per share and they captured so many shares. There is, if assuming there is a down round that's happening, the investor B, let's take investor B's scenario. So investor B will get a multiple as if they invested at 50 cents per share, assuming that investor B has a full ratchet anti-dilution. Okay. So basically that in a series B, investor is 100% protected. It doesn't matter what happens to the company, whether it goes up, goes down. With the full ratchet anti-dilution protection, that investor B is protected in case bad things happen to the business. So that's really what it is. It's as if the original investment came in at the lower PPS, and it impacts what is called the conversion ratio. So at the end of the day, what happens is an investor gets a preferred share, which is the most typical. And the question is, what happens to these preferred share at exit? Okay, so based on liquidation preferences, the investor can take the money out, or they can convert to common shares and participate in the exit. So the anti-dilution basically specify what that multiple looks like. So let's take a very simple example of what I just described, and we'll see what that looks like. So here's an example. So let's say the company, this is one co-founder with 1 million shares. The company did a seed round at $1 per share, and the investor invested 500K, and then they did a seed B round at $2 per share, where the investor invested $2 million for 40% of the company. Okay. So now let's look at this simulation. Okay, let's start modeling out what would happen in case there's a down round. So now we're talking about let's say the company does a price round today. Let's call it seed C, and let's say this is at 1.25 million. Call it, it's okay. We still call it a pre-seed round. So this is where you come in at the 50 cents per share. And let's say this investor is investing, let's pick investor C, that is investing $1 million. Okay. So now if you look at what has happened to this investor B, the investor B originally was at 40% of the company with no anti-dilution protection. And because the company did a Series C at a down round, that investor B came down to 22%. So pretty much the investor got screwed because there was a down round. His interest basically shrunk considerably. Okay. Now, let's say in this example, the investor B says, dude, you know what? Your $2 per share is too high. I'm anticipating you're valuing a business very high, so I need a anti-dilution protection. So in case there's a down round, I want to protect my investment. So if that is the case, then you would, this investor will say, you know what? I need a full ratchet anti-dilution protection for my investment. So let's say this investor was granted full ratchet anti-dilution protection. Okay, so nothing changes. So he still invested $2 million at $2 per share and received a million shares for that investment. Okay, but because there's a down round, that investment of 2 million will eventually convert at 53.33%. So it's as if that $2 million came in at 50 cents.
Got it. Yep.
Okay, so now what happens is, if the company were to go through an exit, so let's say the company exits in 2023, a year from now, the company exits for say $10 million. Now what you see here is that this investor takes that 53.33% of that exit. So now they would have invested $2 million, so they're 100% protected. The $2 million investment gives them the 5.3. So that's the anti-dilution piece. Okay. Yep. So this is really how investors protect themselves from down rounds. This is a very simple example to show the intuition behind it. And there are so many other complexities. So this is assuming there's a Series C and there was an exit. So what happens if it's a Series A round and then an exit? So now things can get very complicated, right? And as the founder, you probably may not have a lot of clarity on top of that. Now, what I have seen on cap tables is when there is a down round, usually a lot of bad things begin to happen to the company. Okay, so the very first typical thing is, okay, the CEO founder gets kicked out. That's the very first thing, because this Series C investor no longer trusts that founder's ability to continue to grow. So bad things begin to happen. So one message I keep telling founders is don't optimize for highest valuation. So if you are at the Series B and you think that $2 per share is too high, because you are pre-revenue and you don't have enough traction and you're trying to raise a 3 million, maybe you should raise it at $2 million valuation, whatever. Just be more reasonable with the valuation, so you're not subject to these kind of down rounds and negative things happening to the business. The other scenarios that I see usually happen is the seed investor who came in with preferred shares during a down round. Usually what happens is the seed C investor, the investor C, would typically come up with a term sheet that says, hey, the seed investor, the angel investors, whomever, today you all have preferred shares. We're going to convert everything to common. Okay, so you don't have any preferred rights to take money out in case of an exit. But if you want to maintain your preferred rights, then you need to add more money into this current round so you can maintain your preferred rights. That kind of screws up the angel investors, and like now the founders' relationship with the early investors are getting messed up because you basically screwed them over, right? So that's how investors look at it, and I've seen lawsuits happening. Right? That happens. It's pretty common.
Oh yeah,
The other thing.
I experienced something like that this year, where
Okay. Yeah.
it was
Yep.
just sort of like you just see like $2 million or what should have been about $2 million evaporate.
Oh man.
Yeah, it's like one of
So
those
it's,
things like, okay, that was
you know,
interesting.
it's pretty sad. Like when these things happen.
Hmm.
The other common things I see is okay, now the series, the seed investor that's running the down round. Typically, this investor C and investor B will usually be the same, because the same investor that is going to be participating in the follow-on round as well. But now they'll require, okay, go create a 25% option pool, a 30% option pool, wipe out everybody on your cap table, and they'll usually do like a stock split or reverse stock split to kind of shrink everything. So at the end of the day,
Yeah,
the
they'll
idea
restructure the
is that
company.
exactly they kind of recapitalize the entire thing, because the intent here is that this seed investor now takes full control of the company. Okay, so what this investor is going to take full control. They want to make sure that their investment does not go to zero. So what that means is that they want this company to be structured properly, so the right individuals are being incentivized properly. They have enough pools so they can bring in an outside CEO potentially, and incentivize that person with say 7% to 10% of the equity. So they start making a lot of surgeries to the cap table, and they can do a reverse split for all the early employees or early advisors. It can be 1 to 5. I've seen, so every 5 shares become 1 share.
Yep.
So they kind of get wiped out very quickly, and whoever is very critical for the business right now, they may get 1 to 2 split. So they start doing all this manual weird surgeries to the cap table. But the intent is really real. So the investor, what they're really trying to say is, okay, you know what? Bad things have happened. Let's go recapitalize this, because I want this company to continue to grow, return my investment, and I want to continue to go raise Series C and Series D or whatever. But they want to make sure that the company continues to be attractive for future investors. So that's what
Yeah.
all this surgery happened. So it's pretty sad, because you see all these early employees, the first employee that came in for 2% of the company, spent the last 4 years building the business, now all of a sudden getting wiped out to 0.005%. So anyway, that's my experience.
I think one of the things that it's like, it needs to not just make sense in the now when you are papering the deal, but you have to also hold, with an open hand. Yes, everybody wants to think, this company is going to be worth X billions of dollars.
Yep.
But the reality is that, about 90% of these companies are going to be in some sort of failure state. And so it makes a way more sense to try to optimize for failure
Correct.
than it is to optimize for success. In that, like, how do you know that, in 3 to 5 years, let's say if you're coming in at that point, so this company, typically it's what, 7+ years for a company to get to that exit state. You have
Correct.
to think, you know, you might not be seen as relevant as an advisor or as an employee. Maybe you don't even work there anymore. And so whatever you've been sold for your options or your equity might not be there, because a company is going to have to, as you said very well, commit surgery on that cap
Yep.
table and restructure the whole deal. And so I think, like, the thing as founders are thinking about what to do over the next few months as they're raising capital, and dealing with the consequences of an inflated market that we went through over the last 2 years or something, where we just saw valuations skyrocketing to the point where it just seemed absurd, is just be very thoughtful about how to move forward with capital raising. And you know, that this stuff can get pretty hairy. People get very sharp elbows around this situation. So thank you so much for showing me this simple round simulation. And can you talk to me? I mean, it's nice to see something simple with easy numbers, but what else can this tool do? And can it help people in like a later rounds? Like what are the capabilities?
Yeah, sure. Yeah, I think so. I'll pick another company here. So this is another example company that that went through like a formation. They raised some money on a pre-money save. They raised on a post-money save. They created like a 14% option pool, gave it a bunch of employees and advisors. They raised some more capital. They raised some more capital. So basically, this is a very typical scenario for a lot of companies.
Yep.
Now, the question is, let's say the company is trying to do a price turn. So if I look at the reports here, assume Marley is one of the co-founders, and she currently owns 55% of the company in her mind. But the company has already raised so much capital using their pre-money save, post-money save, convertible notes. Now the question is, how much of the company has this founder given out, right? So that's the other big challenge. So a very simple, again, back to the simulation again. Now it makes it very easy for founders to say, okay, if I were to run a $15 million pre-money seed round, and these notes convert, so now you see, okay, we just build a pro forma. So it's back to the simulation, but now you can see that Marley is now down to 43% from 55. So the company has taken a lot of dilution. This is just with all the investments that previously was raised. But let's say this company is actually raising, say, $4 million from the seed investor. So the seed investor gets 17%, and Marley is down to 35%. So she was at 55, and all of a sudden she lost 20%. Everybody's lost 20%.
Which means even control of the company, because now she's in a more minority position. And
that's correct.
And the other piece of that that's really important is like she's now upside down, where maybe the incentives for, you know, the long days and the sleepless nights and the all-nighters stop making sense when you realize that you don't really have control or the ownership stake that you used to. And you know, the sense, because I've been there, of bitterness and anger, where you're like, you know, I didn't have complete efficacy and control in this. I didn't understand that I would be put in this position, and I no longer want to do this anymore, which, you know, from the investor's perspective can also be very lethal to the company. Is that, yes, they have a significant portion of that company, but that company is still based off of people. And if those people have lost the incentive to continue to work on something that, you know, doing a startup is probably one of the hardest things a person can choose to do, that it stops making sense. So you could potentially install a new CEO, but at a nice price, because nobody wants to walk into a dumpster fire without tools and resources and incentives. And so they'd have to like re-incentivize. And again, as you were saying, do surgery on the cap table, piss a bunch of people off, risk massive lawsuits. And it can get very, 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 very messy. So this is really lovely. Thank you.
Yeah, absolutely. I think that this is something I keep telling. So founders need to pay real good attention to this, because that's really what investors are looking at. So any seasoned investor, they're constantly modeling out different scenarios for the investment. So they're a spreadsheet guru right now, right? So they're looking at what happens in these different scenarios. And the easiest way to raise capital is to speak the same language as investor. And what that means is that you, as founder, need to get really comfortable with understanding how these notes convert and what happens in upside, downside. And let's say in this example, the company is now down to 6.7% of the option pool. But what if the investor says, you know what, I really need, say, 15% option pool will create it. So what does that do to your company? So you actually went up to 1.88889 million shares. Now Marley is down to 30%. She was 35, so she got even wiped out. So these are things that are very important to think through. And this company is only at seed round, right? Now imagine you need to go to a Series A, Series B, and so that is very important. So in this example, between Marley and Mark, they're like co-founders, so they have 45%. So this is a great example where you're saying, okay, they lost majority of the company.
Yeah. Yeah. And you can tell that in these sort of scenarios, that those founders have started to become disincentivized as their stake becomes significant.
That is correct. That's correct. And most likely they were already 100% vested in the
Mhm.
company. So now technically they own all these shares. It's still a decent chunk, right? But let's say this goes down to, let's say your co-founder, Mark, goes down to 5%. Now that becomes real, what you just described. So Mark is like, dude, I can now go start another company at 100%. So I'd rather go do that. So that's a big risk that a lot of Series A investors think through, because Series A investors typically they won't tell the portfolio companies this, but in their mind they're hoping that amongst the founders they have at least 60% by the time they get to Series A.
Yeah.
The reason is if it is less than 60%, then one of the co-founders is gone below 10% potentially. And if that individual is critical for the business, then most likely they'll pass on that deal, because the chances that 10% becomes 2% in Series B is pretty high. And you're absolutely right. That co-founder is totally disincentivized, and now they can walk out, impact the business. So that is very important from a cap table standpoint. That's super critical. So you should be able to go model out, okay, what happens if we do a price round, say a year from now. Let's say this company does a Series A. Let's assume that it's a 25 million Series A. For whatever reason, the market is still sucky. Now, if you just did a Series A and you brought in investment from another investor for, say, $8 million, okay? Now you see that that investor took 25% and the co-founder is down to 23%. So they're getting wiped out like every time. And things get complicated if this investor were to say, hey, you know what, I need liquidation preferences of 2x, 3x, and that's fully participating. So now
Very
that
aggressive terms, which do happen.
I've seen it happen. It's actually happening to one of my customers. So it's painful.
With the
So
with the 3x preference.
yeah, 3x multiple with full participation. So this company,
Wow.
they're raising capital. Basically, they're in the process of potentially getting acquired, and they need this bridge capital for the next 8 months or so. So this investor is coming and saying, okay, dude, I'll give you the money. There is a high risk that you won't get acquired. So I need that protection in case it doesn't get acquired. So
Yeah.
so
That's very expensive money.
it is, but this is basically to protect the investor in case bad things happen. Then, but that's a term of the investment, right? So, okay, you want the money, I'll give you the money, but these are the terms. So there is another company. It's I forget. I think the Expedia. I think like before they went public, they had done everything 1x liquidation, non-participating their Series A through Series F or whatever. And when they did the Series G, it was the same thing. So liquidation preference was 3x fully participating, and then they went public with that money. So when a company goes public, all the liquidation preference disappear. So that's the only time it disappears. So that was that investor trying to protect their interest in case that company didn't go public. So you got to watch out for this. So you got to see what happens in those scenarios.
Yeah, that makes sense. What else? What else do you want to show me?
Oh, so from a product standpoint, okay, so you can generate all kinds of reports. You can do board consent here. You can run simulations we talked about. You can sign documents because we see that founders are constantly using DocuSign or one of the other HelloSign. We implemented our version of it, so you don't have to pay $60 a month on other services. Then we have doc sharing and tracking. So,
Is that
so
for like
it's
your deck and stuff?
yeah, exactly. So if you
Oh,
have
that's
investor
fantastic.
decks, you can actually because at the end of the day, the way we think about this is the fundraising is a marketing exercise. So you build your deck and you send your deck to 50 investors, and some of them may not even look at your deck. Some of them just run through your deck in like 5 seconds. The others might actually spend time looking at every page of your deck. So those are the ones who are more engaged. So using this tool of ours, you can actually now go and see, okay, who spent how much time. So this founder spent 1 second here, 2 seconds. So he was
That's
not
very
fully
similar
engaged.
to DocSend. I
That's
saw
correct. Yeah.
an interesting report from DocSend showing that the average time an investor spends on a deck, no matter how many pages, is 3 minutes. So,
Okay. And I've seen like people just run through. They just run
oh
through it
yeah.
like in 2 seconds.
Well, the
Yeah.
reality is like as an investor, like you could be looking at 1,000 decks or more. And so it's like you get that pattern recognition
Yeah.
and you'll just quickly and then
Right.
you'll find you'll fixate potentially on one
Yep.
or two of the slides that are important.
Yep.
And
Yep.
a lot of times like and I've had this argument as I've been supporting founders where I'm just like you need to cut your slide count in a third so that the 3 minutes that you get are actually spent on the most important things and take the
Yep.
time to make sure everything is legible and that everything
Yep.
that you're saying is impactful. This is not where you put 500 words, because it's
Yep.
just not going to be read and you're just going to the micro irritant of it. Yeah.
Yeah, I think the ones that I've usually seen, one is typically the market size. Basically, okay, the very
Mm.
first slide, okay, then what is the market problem?
Yep.
Then typically, what is your traction slide? They spend time. Then they
Yep.
look at the team and they look at what you're raising, what are the terms of investment.
Yeah.
Everything else is fluff for most of the investors.
The slide that I like to spend the most time on it are two. So it's like one, do they understand the problem? And two, do they have alignment between the problem and the solution that they're proposing? And do I believe that there is that sort of like viability of the solution?
Yep.
So that's where I spend most of the time because it's like the reality is that I'm using that as a mechanism to assess at an early stage a founder's ability to understand a problem and propose a solution. Because the reality is that that they will continue to have to solve problems and that a
Yep.
lot of times the solution that they finally bring to market with that product market fit is going to be very, very different than
Yep.
what they're initially proposing. But I want to see that they understand how to solve for a problem. So anyways,
I see. So from your standpoint, so you kind of focus on pre-seed stage, like pre-revenue type companies. Is that your sweet spot?
as a smaller investor, that is the place in the kiddie pool where it's easiest to play because the
Yep.
check is more impactful. The smaller check is more impactful. And also just from a personal mission perspective, like if I want to be able to help more diverse founders, the reality is that there is diversity in the beginning.
Yep.
And it doesn't last because it's incredibly difficult for those founders to continue to raise. And though I haven't figured out how to solve for that problem specifically yet, I thought the place that I could be most impactful was in the beginning. Yeah.
I see. So, and then I'm assuming you look at the team. So team is very important to you, I would imagine, and that's it because they have nothing to show for, right?
Yeah. I mean, I think as a founder, you have to think like yes, you have this gorgeous deck and clearly you've thought about it, but the reality is that the investment is in you and your ability to solve a problem, from do they have any empathy for the other side that's writing that check? And to be frank, a lot of founders have zero, they don't spend any time thinking about how the investor perceives or thinks about them, there's very little empathy and understanding on that side. And there's a lot of sort of like this dehumanization where they're just like, well, this person has infinite money. They've just raised $50 million. Why can't they give me 5? And it's, well, I'm like, you don't even fit within their thesis. Like, you're just wasting this person's time, and their time is very valuable. So how dare you? You know?
Yeah.
So,
So how about
yeah.
do you, from your standpoint, right? So I'm sure you're looking at least 10 deals a day. At least you're talking to 20 founders, I would imagine, every day. So for you, in your, just you personally, like if do you care for a particular industry, or is it a problem that you already thought about? So let's say I'm selling coffee beans and you don't care about coffee beans, then can I still get investment from you, or it just doesn't fit your thesis and you need to spend another 3 months trying to figure out that market before you invest? How do you think about it?
You know, I think every investor is different, and they, you know, this is one of the other things that seems to not be understood really well. It's like, as an angel investor, you have complete discretion over how you invest. You might have taken the time to have put together a formal investment thesis and have an investment plan where you're like, okay, I'm really passionate about X, and I want to put my money where my passion is. And I'm being very thoughtful in the words of passion and stuff like that, because sometimes, you know, it's not really about the return. It's about deploying capital. And so from a fiduciary's perspective, somebody that is managing somebody else's money, like a venture capitalist who have their own investors, they have taken that capital under an investment thesis, and they need to match the funds to that and the thesis to the funds that they're deploying. So they're like, okay, this needs to fit within this certain criteria, and they could see a fantastic investment where it's just sort of like, wow, everything on this looks great, but it's adjacent, but I can't have that conversation with my LP and say, yes, I've requested funds that do not match this. And to be fair, like a lot of VCs also have like some discretionary investments, but you don't know what those are. And they also tend to have like a minimum number of investments they have to make over the duration of their fund. So a typical venture fund is a 10-year agreement, and it's typical for the primary investments to be made within the first 3 years, and then there's typically some reserve capital that's then deployed to deal with like the different simulations that you just described to help maintain your position, or if you see traction in that company, help them grow, or if the company is experiencing like the kind of market that is currently happening, you can then reserve that capital to try to keep your companies, the most viable companies alive during adverse economic conditions. And so like they have to make, circling back, they need to make, let's say the average venture capitalist is making 35 investments over that 10-year term. That means that they need to be making, 10, 11, potentially 12 investments a year in order to hit their numbers. And so like you might be looking at 1,000 decks in a year, but you're only going to write maybe 10 checks. So it's a very, very small percentage that actually make it through. And it's some part of it is personal, because you have to be looking at, as an investor's perspective, you have to look across the table and be like, one, is this person trustworthy? Or are they going to, just take this money and they're not going to be thoughtful in how they invest it in the growth of this company? And am I going to be sitting on the other side of the table in 3 years as they're looking at a down round because they didn't actually do what they said they're going to do? Or sometimes things are out of their control. And how are they going to handle that? Do they have the capacity to handle the amount of stress that being a founder is, because it's the sleepless nights and it's the drive towards the thing that you're passionate about, and can they sustain that for literally years? So it's like, I'm looking for those characteristics of, you know, trustworthiness, intelligence, integrity, and that sort of like that grit
Yep.
that is necessary uh beyond even, you know, the specific knowledge for that specific thing that they're trying to innovate against.
Yeah.
Okay.
I
Anyways,
think
you got
that's
me
awesome,
going,
actually. Yeah,
Rajesh.
no, that's good. This is good because I think like many founders need to hear this, right? So how an investor is thinking, it's super important because we see a lot of founders. I spend a lot of time in accelerators talking to different founders, and the biggest problem that I see is they still don't know if they have a business or not. So and whether they have a business, is it a venture-backed business or is it a lifestyle business? So
Yeah.
they're still trying to figure that out, right?
They
So
don't
so
understand you know, venture worthiness. And I think it comes, you know, specifically down, have they taken the time to think about
yeah,
the exit and what they're asking. So if they're asking
exactly.
somebody for $1 million, they have to understand that they need to be returning
Yep.
more than that $1 million. And a lot of times they don't even think, oh, I have to return this money. They just think it's free money. And you're like,
Yeah.
no, man, this is the most expensive money on the planet unless you go to a loan shark. And even
Yeah.
then, you know,
Yeah,
it's like,
yeah. Like, I
get
think
out of here.
the important thing is VCs want to see the investment return the fund. So if I'm a VC, a
Mhm.
$25 million fund, and I put $1 million,
Yeah.
I want $1 million investment to return 25 million. That
Yeah.
is their math. So,
You have to
so
because of the mortality rate.
exactly,
This
exactly.
this is
So, uh,
the
and there
math
are companies out
sucks.
there
You know?
that are like a services type business where they might generate a cash flow of 30,000 month over month, but there's no opportunity for them to scale and grow, which is very typical a lot of the services companies. Then it's in my opinion, it's not a venture back company, but it's definitely a lifestyle business. There are a lot of investors out there that like that cash flow deal.
Yeah.
So they just need to be careful who they're pitching and what that looks like. 'Cause otherwise, they go raise from a venture investor, and it doesn't scale like a venture business. And now it's technically a down round. It's technically surgery to the cap table, founder getting fired. So bad things happen. Yeah.
Yeah, absolutely. I think a lot of people tend to be on that side of like, you know, just take the money and run.
Yeah.
And they don't understand the long term or even relatively short term because it's, you know, always be raising,
Yeah.
you know,
Yeah. Yeah.
always
Yeah,
be raising.
always be raising from the right. So
Yeah.
there's another example. One of my customers, she received a deal term for like $1 million for 50% of the company, right? So and she wasn't even sure whether she would be $1 million is very enticing. Like you're tempted to take that money, but
Sure.
you pretty much wrote off the company because the only place you'd that founder would have potentially raised money is going back to that same investor. So now the investors say, hey, you know what? I'll give you another $200,000, but I need another 30% of the company, whatever, right? So now you're in the terms of that investor.
You know, I haven't understood investors, and this is just maybe my own um, faults as an investor, but that are trying to take more than 10% of a company at any given point, because you have to
Yep.
think like you don't exist inside of a vacuum and you're the only money going in,
Yep.
or the only money that will ever go in. And so like when a founder is raising more than 10% on a round and they're not doing it very thoughtfully, that's an immediate red flag for me, where I'm just like, okay, this
Yep.
person is clearly not thinking about their exit scenario. And they're just looking, they just think, oh, I just need all this money right now. I'm like, do you even have a plan? Why do you need all this money right now? Why can't you take down half of it? And, you know, and sometimes, honestly, it's on the other side too, because again, like if an investor has written, you know, up a deal where they have a venture fund, let's say it's $50 million, and they got to make those, you know, 20 to 35 checks over that time, they're limited by check size. And
Mm-hmm.
so they need a bigger round. And so it can be kind of like, wow, like you only have access to these investors if your deal is big enough that they can fit. And at
Yep.
the other end, it's like if you try to increase your round size so that you can attract more investors so that they can write you checks, you might end up in an upside down space. And so it's it's a difficult space to try to walk between like the most rational thing that you can do for the long-term success of yourself, your team, and your company, and the your need for cash in the now, to keep growing and
That's
to stay
correct. Yeah.
relevant.
And I think from an investor standpoint, the math is very simple for them. So if you are a biotech company that requires FDA approval and it's going to take 5 years before you can be revenue positive and you want $5 million from me, then I as investor might say, dude, I don't care. I need 30%. Let's start with 30%, 35%. That's going to be my investment in this company in this round, because I'm expecting this company to go raise more capital and my 35% is going to go down to 10%. So now tell me that you'll be $1 billion company, so I get my 10% of that at exit. So it's very simple math that they work off of, and that's how they arrive at that 30%, 35%, or whatever that number is. It's very simple, and then they start drilling down into the details. So your industry makes a difference. Yeah.
There are certain industries like you mentioned, like biotech, that the event horizon for it is just so far off and so expensive that this is the only way to make it happen.
Correct.
And in which case, then there are investors that just specifically do that. Like I love everything that's happening around protein folding and CRISPR. But the reality is that it's a very different investment than in, software as a service, or even
if that is interesting to you, I have a customer for you. Then I have a potential investment for you. He's a really
I
good
just
guy.
told you. I just told you that they.
Yep, got it. Yep.
It's a much different game making those investments, and you got to tool yourself specifically to and that's one of those other things. It's like the investor is tooled specifically to investment type, and like one of the easiest ones to look at is software as a service, and it's just simply because the math is more straightforward. And the other part is like, if you have software that has a customer, that's much more difficult to kill than other things. Like the maintenance and cost after the product has been built is relatively low, with some exceptions, but it's relatively low. So there's actually a whole industry that exists basically to disassemble those and reassemble those companies, once they realize that, no, this software as a service company is not really venture worthy, but we've put all this capital into it and it has customers and it's not going to die and it's just going to keep on spitting off a little bit of cash, but never enough to make anybody really interested. So, yeah.
Yep. So what else, Tiana? Like, what are the other interesting topics here?
Dude, have you been seeing what has been happening in the crypto markets? Holy moly.
I know.
You see, I know
painful.
that's totally off topic, but I have to, that's why I got my little Bitcoin mug out of like, wow.
It's a down road, right? So that's a down
watch
road,
everything
right?
burn down again.
So I saw this letter from Sequoia to their LPs today. It said all their investment in FTX is being written down to zero. It is like
You want to talk about a down round?
Yeah, exactly. So they just wrote off the entire investment of 180 million or whatever. It just went to zero. But the fund is still up like $1 billion in unrealized gains, or whatever that means, right? So hopefully there's no more crypto exposure for them. But
I think crypto is one of those investments where you look like a genius for like a couple of years and then you look like a complete bozo. And I think as far as opportunities go right now, that it's sort of like one of those things where there's like, clearly there's a market demand for something. And there's customers, there's a thing, but at the same time, like wildly overvalued. And so is this an opportunity to go and do M&A and pick up the pieces of things and then reassemble them? And I'm pretty sure like we're going to see a pretty interesting sort of like market consolidation.
So here is an interesting thesis that I heard, again, since we are just talking, right?
Yeah.
It's just one data point. So this is from one of our investors who's been in the PE space. He lives in New York, so he's been kind of hearing this in the background. But I like the theory, but Dustin, he's not fully convinced about the theory. But the theory is that
That's why I
most of
like you
the
guys as a team.
I know, like we don't agree with everything all the time. But the
But
theory
you
is
still
pretty
like each
interesting.
other and you still work together. So I'm like,
Oh
ooh,
yeah, yeah, we love each other.
a
Yeah, so,
better
yeah,
spectrum on thoughts because you don't have that echo chamber. You guys
yeah.
actually um I think there's a lovely balance between the two of you as found as
Yeah,
co-founders.
he's very optimistic. I'm super pessimistic in a lot of aspects. And then we brought in Young. He's somewhere in the middle. So I think the team is good right now. So Young is usually the tiebreaker these days. So but anyway, back to the theory. So in June of every year is where the endowment funds and the retirement funds basically put out their results,
Yep.
and they have majority of the investments in liquid assets. So they invest in public markets and real estate or whatever.
Yep.
But the projection is that they will have like a single digit or almost 0% returns to show for this year. Okay, for 2020 to 2023. So meaning they won't be able to. They don't have enough returns to meet their commitments for next year. What that also means is that they will start thinking about allocating a big chunk of the capital towards the VC side, because VCs are the one that gives skyrocketing returns to make up for the loss. But at the same time, they hate being locked out for 10 years or 12 years when they invest in VCs. So one thesis is that there'll be a lot of interest in investors that can help with liquidity, right? Instead of 10 years, what if you have a 2-year liquidity window, 3-year liquidity window? So that is something that this investor friend of ours was basically theorizing that might happen. So he's expecting a lot of money to flow to the VC world after July of next year. But the ones that have liquidity component built in could be interesting. So that was a thesis he came up with. And surprisingly, we got hit by 2 different VCs who came to us asking about our secondary liquidity methodologies.
Yep.
And we have a call with them tomorrow, actually, with one of these companies. They're asking, hey, how do we think about liquidity? So that's one data point that makes me believe that this investor friend of mine could be right. But I thought that was interesting to see. Okay, money is going to be locked for until June, July of next year, but it can free up next year, assuming the companies are prepared for quick liquidity. I think something like that could happen.
One of the things I thought was interesting, and this will sort of be like, what we learned in 2017 in the ICO craze and all the
Yep.
names and derivatives they came up with after that. But it was like this idea that people are willing to take extreme risk for a relatively
Yep.
short amount of time.
Yep.
And under the current sort of rules and regulations, there's tax benefits to holding an asset for at least a year. And then you could potentially even roll it into other companies that haven't raised, I think the cap on that is like $1 million or something like that. So you could basically keep on rolling your wins into other companies and optimize your taxes that way, while offsetting the risk. Because it's like if you're throwing capital into a company at the riskiest time, in that initiation, and then you got to hold on to it for 7+ years. Like it's just sort of like but if you can turn that capital and say, okay, like I rather take a 2 or 3x, but I'm turning my money every year or every 2 years in small cap liquidity events using timed auctions or something like that, where you have a single point where you're then bringing a market together and clearing it out so you don't end up with these wild swings and things are planned. I think that would be really gorgeous. And that was actually one of the reasons that I put capital into you guys so many years ago was that you guys were also on that train and understanding, having empathy for the early stage investors that are really helping innovation get off the ground, but not able to sustain, because it's sort of like, the later stage investments, they're not having to hold it for as long, and they're dealing with de-risked assets. And so there's very few people that are down at the other end in the beginning space. And it's only those that are sort of pushed down by more institutional capital that's able to come in with bigger teams and stuff like that. So it's like, the market has definitely been in their favor for a long time. But I think with new crowdfunding regulations, Reg A and Reg D, where a founder can raise capital, 75 million, without having to talk to a VC, is really,
that's
really,
correct.
really
And those investors have immediate liquidity as well, right? So even the crowdfunding investors, they can exit their position anytime when there's a market there. So I think market is going to be very interesting next year on. It's going to be super tight, but you're right, there'll be a lot of M&As. Maybe PE firms are looking very closely at how this. There might be investments coming in just to facilitate some acquisitions and M&A activities. So yeah, it should be an interesting next phase. And I know everybody is kind of turtling up right now, because we've been acquiring a lot of customers because they don't want to be spending $10,000 on cap table management. So for them, it's a no-brainer. They just switch over to us. I'm already seeing that the pressure being built with respect to how to position businesses for sustainability for the next several months, and then look for more fundraising in the future. So it's happening. We're seeing we're in the midst of that.
That's awesome. So why don't you do a quick plug for 212? I know you guys do a bunch of really cool stuff. So you got your 409A valuations, you do the special purpose vehicle formations, and then just like a reasonably rationally priced cap tables. Can you give me a quick highlights of what they are and why founders and investors should consider these tools?
Sure. Yeah. So both Dustin and I, we've been at startups before. We've had the same challenges about lack of visibility of equity, or we've been spending a lot of money on lawyers to manage lawyers and accountants to manage our equity. So the problem is a lot of founders end up making these mistakes of agreeing to crappy terms. So what we did at 212, okay, let's go build what we call the founder's birthright. Equity is the most valuable asset they have, so they need complete understanding of what's happening with equity, what happens to deal terms, what is the impact of the deal terms on their ownership. So we build anything around equity for founders. And along with that, they need a lot of other toolings, like the ease of managing board consent, managing your option pool, inviting investors, modeling of scenarios. We have a data room with 1 gig storage built in. We allow them to sign documents on our platform. We allow them to share like a DocSend equivalent. They can send investor updates, so everything for $20 a month. And the key value differentiator for us is we don't price our customers based on number of shareholders, which is what everybody else does.
With inflation, that's almost free.
Exactly. Yeah. So we try to give away a product for free, but founders didn't want free product because the question was, how do you support a free product? So we $20 seemed to be a clearing price for us. So we kind of bake all of these, and the reason we are able to provide this at $20 is because our technology, we are technology and we're not a services company. We are a technology company. We kind of build how this entire equity math works and host that on an Amazon cloud instance. So now the compute is basically doing all the work for humans. So that's how we are very different from all the other equity management companies. Outside of that, we help founders understand the valuation of the business. We can also help them generate the P&L cash flow balance sheet projections for the next 7 years. And to your point about our acquisition of the SPV business a couple of months back, and we are the only one that is white labeling our solution to different capital allocators. The idea behind this is our vision is to be the rails for all the equity management across startup ecosystem. So meaning if you are a startup and you raise capital in your pre-seed, eventually you can now go in and say, okay, I want to be discovered by my seed investor, and 18 months later, I want Series A investor to discover me. So we make it very easy for founders, cap table to move from one capital allocated to the next. So that's stuff we think about our solution, and we want to make it super inexpensive for founders to continue to raise capital and build business, and for investors to find great deals. So that's the overall vision for where we are heading towards.
That's fantastic. Well, thank you so much for your time today and being patient with all of my questions around
Great questions.
Down rounds and dilution and all that stuff, because I feel like it's really important, and thank you for taking the time to go through it so meticulously with me today.
Awesome. Thank you, Tina. It was a pleasure. Thank you so much.
Okay. Have a great week. All right. Bye.
All right. You too. Bye.